We're going to talk a little bit now. Big part of the theme is how organizations can get funding, how we can develop sustainable funding streams and social enterprises and ventures and things like that. So, talk a little bit about, introduce yourself in case people haven't met you yet, and tell everybody what your perspective is on that and how you got into that space.
Hi, my name is Tanaha Hairston, and I'm from Arizona. I have a company called the Impact Investing Community Capital. We connect investors with private impact-based opportunities such as real estate and affordable housing and first-time home ownership, and that provide them passive income and tax benefits. And how I got into the space, two reasons. I was married for 16 years, and my ex-husband was a professional athlete. So we did a lot of philanthropic work in organizations individually and also with our teams. And I was also an early investor because whenever your salary is public, everyone is coming to you for private deals, private investing, private deal flow. We were the worst ones that should have been solicited for like startup opportunities, but yet everyone is always pushing you to participate in new ventures and new opportunities. How I got into what I do now is I marry the two, the philanthropic with the investing, and we have two impact investing funds and opportunities with my partner and I. So that's what I do now.
Nellie?
I don't know if it's on. Can you hear me? Yeah.
Yep.
Okay. I started out, you heard my story earlier, and just wanting to diversify my portfolio, being an investment banking for 13 years. During that time, my husband and I wanted to start giving back, and we started going down the path of looking at helping people, specifically people that were impacted with the issues of substance abuse, because we had been impacted with that in our family. And at the time, there was a lot going on in the world where we were cutting back funding for treatment programs, and they were closing down treatment programs in the 90s. And I mentioned earlier, and also in 1994, they passed that crime bill. So we knew that this was going to be a pretty bad situation for someone that was dealing with substance abuse issues. Three strikes, you're out, you're going to prison, mandatory minimums. And having been through it, it was personal to us to know that people that were dealing with these issues had basically no way out. They're going to end up in a prison system, especially if they didn't have money for lawyers and for treatment programs. So we felt personally obligated to want to do something about it. And as we did research, we found out there's really nobody thinking about it in the way that we were thinking about it in terms of trying to solve it. So we just said, well, we wanted to diversify. We wanted to buy real estate anyway. We were kind of locked into the, stock market. And we said, we really should do something. And I was investing in real estate investment trusts at the time. So I had already sold myself on the idea that it was a good time to start buying, large apartments. And we started buying in distressed neighborhoods in Chicago, like Logan Square, which is now considered one of the hottest markets in Chicago, but that back in the 90s, it was. And in, Rogers Park and some of the other neighborhoods that were distressed, and just started buying real estate, gutting them, renovating them. And we said, hey, instead of like just turning these around and renting them like most people do, why don't we just use our own properties, hire some people, help a few people that might need some help, and we'll call it a day. We'll do it for a few months and da da da. Well, as we were meeting people, and this was literally saving their lives, we had to figure out, how do we make this sustainable? We can't pay for this forever, and people don't have money to come to us. So we started going after government funding, and we said, hey, there's people that have come out of prison that you let out that ended up living on streets. Why don't you just send them to us directly? And we've got this place for them to transition. And we started the very first reentry program in the state of Illinois by just giving them the data that showed what we were doing was working, and they were mainstreaming and they weren't recidivating back into the system. So that was the first way that we came up with that allowed us to get funding to do the work that we were already doing.
So talk a little bit about your fund,
Yeah.
right? How you raised the fund,
Yeah.
number one, and then two, what is the profile of the type of investments that
Yeah.
you're looking to make?
Yeah. So, first, back when I was an athlete's wife, right? The process is the teams would come to us and they would ask our whole body, like, what projects do you want to support and you want to give? So fundraising was very easy during that time. It was like so easy because all we had to do was have the athletes show up and money would just come pouring in. So that was so easy. Post that time, I've been on other multiple boards, and fundraising when you have a nonprofit is difficult, right? Because it's just you always have to, go out and find that next donor, the next donor, the next donor, the next donor. And so what I do now on the impact investing side is it's a beautiful flywheel because once somebody invests, they're getting a return and their money's actually growing. And so therefore you're not always soliciting that next person, that next person, that next person, that next person, that next person. And so it really becomes a scalable model, that way you don't have to keep doing it over and over and over again. So what we do now is we have a real estate opportunity fund to invest, and that's really nice because it's very simple. Everything that we do is profit and purpose. So on our real estate side, we're providing first time home ownership. Our returns are always above market rate, 15% and higher, and we're typically 2x in capital. We look at that and we can quantify the number of people that we're helping, and we send that out quarterly. That's a big part of whatever I do. I don't send anything out unless it's profit and purpose. And then we also do a big part of what I do is education, because no one educated us. No one educates the athletes. No one educates the families. No one, when I want to do my first private deal, my financial advisor actually dissuaded us. And so I do, if you Google me, I do a ton of education. I explain how to invest in a private deal. I explain how to break it down. I explain how to look at the management team. I'm so passionate about that because no one ever educates you. They want to take advantage of you. They want you to give them money, but they don't want to actually educate you. So that's a massive pet peeve. And that's a driving force for me to educate. While we don't even have, if we don't have an opportunity, if we don't have an amazing real estate opportunity, we always counter that with a debt opportunity. And right now we have a debt deal for first responders in the military, which I fell in love with. Again, every $50,000 it's IRA eligible. We help 33 first responders and military families, and it's a debt consolidation program for them. They're put on a payment plan. They pay their debt off in 18 to 24 months. So we always have an impact opportunity, and we can quantify the number of people that we're helping and what the returns are. And that's how we talk to our investors. We spend a lot of time educating. So there's three things that have really helped with transitioning from that philanthropy model, which is why I love the impact investing model, is number one, community and capital. You have to sit together. So you sit down and you educate and you give everyone ownership. Times are different from, when we were players. Now people want equity, they want to be a part of it, they want to sit down at the table with you. And so bring them, I would say, bring them. That's what we do, right? To anyone who wants to get involved, anyone who wants to participate in impact investing, we bring them along the journey, we explain and we educate. So that's the first thing I would say. You can't grow. We all are doing beautiful work, but in order to truly scale, we have to like sit down together and we have to talk about how we're going to grow together, whatever that is, by everyone having a contribution. So that's the first thing too, is the recurring model. That's another thing that's really nice to implement because then you're on an impact flywheel and you're not constantly asking for the next and the next and the next. And then the other piece is the legacy. Like athletes and people, especially my network and athletes before, everyone, they want legacy. So they want to build something and they want to be a part of it. We do. We want it for our families and they all want it too. Everyone in our community wants that. And that's the best thing that we've done as we've transitioned to the impact investing model. We always have above market returns. We always have an impact component. We're not sacrificing any of it. We're all doing great work. The only difference is that we're doing it together, and that really is the differentiator with scaling, and the way that we have our structure. So I'm happy to talk about that. I had somebody who was the president of the board for Banner Hospital, and he literally outlined how they have their nonprofit holding corp structured, what that reports to, like all of the other for-profit entities that the nonprofit holds, and he walked me through that structure. And that's really how you build and how you grow. And I'm happy to share that. That's how we have ours structured similarly. And so that was really good advice. But that's the best thing. That's the only, those are the three ways to scale: flywheel, having everyone be involved, capital and community coming together, and then that legacy. That's how you build something that scale, and partner with impact funds, right? That's another opportunity as well. And then have that piece in there. So where, everyone can benefit, because when someone's getting a return, when someone's getting a return, right? Then they're not like wondering what happened with my money, right? What happened with this, or what's going on, because they're actually seeing it, and then you're actually telling them the number of people that helps. So those three things are a huge shift to scalability, and that's the game changer.
I think one of the things that I get asked a lot, is Nellie, you run a nonprofit. How did you start? How do I do it? I want to do what you're doing. And my question to them is, why does it have to be a nonprofit? Because you can make an impact with a for-profit just as much as you can make an impact with a nonprofit.
Sometimes more.
Yes, because no money, no mission. So, my husband and I didn't start out as a nonprofit. I told you we bought these buildings with our own money. And when we were buying these abandoned buildings and we're putting millions of dollars of our own money to renovate these multifamily apartments, and we didn't have a revenue stream, there was no banks that were going to lend us a dollar, right? So we brought in investors and kind of just pitched them on the idea. Said, look, we're buying these properties, we're going to wait the market out. The way we're going to make money is we're going to sell them, down the road. But in the meantime, guess what? We're going to make a lot of people's lives better for it. And people were like, you know what? I don't think it makes any sense, but okay, well, we'll help you. So, we were true to what we said we were going to do. And, guess what? We didn't sell these properties, but once I started getting funding from the government to start helping this reentry population, I showed that these buildings became profitable, very profitable, to the point where I was able to buy out all of the investors and give them a much higher rate of return that they would have gotten otherwise. So those are the for-profits. I didn't turn into a nonprofit. I mean, I kind of had a hybrid thing going on until an organization, the largest homeless organization in Chicago, had built a building, got in way over their heads. The city was scrambling, trying to find someone to take the asset. Otherwise, 400 people were going to be put on the street. So we participated in a due diligence process. We were selected as the best buyer. We bought it in a nonprofit. So we had these parallel, things going on. So it was my first time owning and managing a nonprofit after having started in 1994 as a for-profit, running social programs, successful programs until 2010. And in 2010, we took over this nonprofit. It's my first time to actually think about donors, right? But because the organization had been in such financial dire straits, they're about to go under, my 990s, I learned, didn't look so good. And there's a 3-year look back. So I had to think really quick, if we're going to get money, I have to figure out, how do I generate revenue? So, we had already done social enterprises. I had overnight a Department of Labor contract, which we were being celebrated in Washington, D.C. for being the best workforce job placement organization in the country out of 18 in the country that were funded to help reentry populations get job training and get jobs. We were being celebrated for that. And I was told that our contract was not being renewed. That meant that my entire staff was going to have to be laid off. I realized I was super vulnerable, which meant, hundreds of people were no longer going to get those services. So guess what I did? I bought a staffing business. So the staffing business became my revenue stream that allowed me to keep my staff. And now I have a staffing company that has relationships with employers. Today, I'm more focused. I sold the underlying business out of everything I was doing. It's kind of like McDonald's. I was really in the real estate business, right? So I was buying and owning and managing transitional, supportive, affordable, senior, veteran housing. Some of it was privately owned. Some of it was owned by the nonprofit. It didn't matter. We had a management company that just managed all the real estate. But today, in 2022, I sold off a bunch of my real estate. And I'm pivoting into, I know the whole world is moving into affordable housing. I'm kind of going in the other direction. I always go in the other direction. Today, I'm buying market rate, and what I'm doing is I'm adding affordable components to it. So if I'm buying a perfect example, I just bought about 6 months ago a 53 unit apartment building, just delivered 2023. Beautiful, new. There's an incentive program in the state that allows you to convert 15% of your market rate units to affordable, and it drops my property taxes down dramatically to the point where my investors, where I might be making a 9% return without the affordable, with the affordable, it's in the teens, right? So I'm looking at always ways to participate in expanding and building in Chicago, for example, where I'm investing right now, is short 220,000 affordable units. And to build something, the last thing I built in Chicago was a 90 unit veteran housing project. I delivered it in 2022. That cost me 300,000 per unit per door. Today, to build that same building would per door would cost me about $700,000. So you could see why I sold in 2022, right? And as inventory is coming up, that's new, that built in the 2000s or 5 year notes are coming up. They're looking at refinancing. I'm scooping up things at a big discount to what it would take to buy. So I'm immediately activating my money. I'm cash flowing immediately, and I'm already baking in returns, because I know that my competition right now can't build for what I'm buying. So I'm always looking at real estate and how can I use it in a way that's going to do a social good, but also provide myself and my investors a superior rate of return.
And I think that that's really an important point. You talked about if you've got a for-profit side, right, you can use those funds in any way that you choose. If you've got a nonprofit side, people think that being a nonprofit means you open up the doors and the money comes flooding in. I can't tell you how many athletes and other people starting foundations. They're like, oh, the world is going to change. I just got my 501(c)(3) status. I got my determination letter. So now all the money is just going to come running in the door. And so anybody that's worked in a 501(c)(3) understands that's just the starting point. You now can access certain types of funds, but it's not necessarily easy, and it's not necessarily coming running to you unless you already have a big name, maybe as a professional athlete.
Yeah, no, 100%. So my time during our 16 years, right, whenever we would always pick a philanthropy that we would support as a team, right, and we do an event, raising funds, was not that difficult, really, to be quite honest, because we put on an event, all the players would come, and then people would pay to have access to them because you have the whole team there. Post that, and the boards that I was a part of where we would try and raise, oh, it was like watching sugar drip from the like wine glass. It was like so slow, and you had to keep doing it over and over and over and over again. So I empathize because I know both sides of it. One was, wow, this was pretty nice, so easy. People would just pay for access for the whole team. And then post, all of a sudden fundraising became much more difficult. It was easier before. So, but the other thing I wanted to say is that, when we were athletes, we should have gotten deals like this, like where either you're the bank or you're investing in a real estate project, but yet our agent and others, they would present us again with these like startup opportunities, and that's like the riskiest of all the asset classes, and they would just show us these opportunities, and we were like the worst person that should have been investing in that. We hadn't had an exit, we hadn't had a great career, to where we had run an organization and we knew how to use KPIs and build and scale, but yet we are being presented with these kinds of opportunities. And it really wasn't until much later, when I ran an angel investing group, that I really learned how to analyze these deals so perfunctory. So um a lot of it is the gatekeepers that you have that are actually presenting you with these deals that we had no business investing in. We had no idea how to do proper due diligence, no idea. Instead, we should have been presented with, deals where you the bank and that debt fund that I showed you, or a real estate property, where somebody has negotiated a great deal, on an asset. And then you can have profit and purpose. But that was our experience, and it was really for all of the players as well. Go ahead.
And you talk about it, it's so important because athletes get a lot of people coming to them
Yeah.
thinking that they've got huge amounts of money, right? And
Yeah.
in comparison to, let's say, team owners,
Yeah.
right?
Yeah.
The amount the athletes have is still small,
Yeah.
right? And especially as they're starting out. And they get talked into businesses, as you said, that are not the
Yeah.
best asset classes, restaurants, nightclubs, things that are risky businesses where somebody's really trying to trade on the athlete's name, right? They're really looking for something where they can leverage off of the athlete's relationships to bring people to the venue or to parties or whatever the case may be. And there's a lot of, we call them ugly businesses. And I had somebody that invested in things that you wouldn't even consider, like worm farms. Like, where do all the worms come from that people use for fishing or for bait or for, uh, you know, other little small pets or things like that. And you watch this operation that this group had built, right? It's not a business that you would think, but it's a cash cow, right?
Mm-hmm.
It's ugly. You're shoveling dirt and you're sorting worms, but it's not going away. It doesn't depend that much on the economy. And those are the businesses that are hard to find, but they're not glamorous.
Right. Right. And do you go ahead?
No,
Do you
go
want to say?
no, go.
No, I was going to say, and then no one imparts that education to you throughout that entire process. To your point, even just really 2 months ago, famous Suns player, his son, they're doing a big, massive, restaurant opening with a famous chef. They invited me to come and look at the investor pitch deck. And I'm not going to say the name, but, you know, athletes were there. And I thought, here we go again. Why are you bringing these people in this deal, with this restaurant club lifestyle concept? They're the last people that should be investing in this, right? They don't have the relationships and connections to move this deal if they need it to progress. They don't understand how to analyze if this is a good opportunity or not. Literally, this was just very recently. And the people that were behind it, one of the chief partners, right, was a notable basketball player. So there are many non-sexy businesses that would have been great opportunities. And for some reason, we saw, all of these startups that we had no business participating in because we didn't have the acumen to be educated investors and informed investors in those opportunities. We didn't see the boring deals somehow.
Okay, another thing is, I pay very close attention to, um, trends, and policies. And I sold in 2022, um, and I'm buying again right now. But when you think about what's happening in Washington right now, for example, with HUD, a lot of the stuff that I was doing was really dependent on Section 8. You know, and today, if your business, your real estate is dependent on Section 8, you're about to get a big wake up call, right? Because a lot of those programs are getting cut big time. So I'm familiar with the last administration, what they did. And I was actually, believe it or not, called out of the blue to come to the White House and speak with cabinet members about this topic. Has anybody heard about opportunity zones? Okay, so opportunity zones were incentives for real estate investors to invest in distressed communities and get a tax benefit of holding on to your investment, whether it's a business or a real estate deal, for 10 years and selling it on keeping all of your capital gains tax free. Because this is the areas that I was, known for investing in Chicago, and a lot of the communities that I invested in gentrified, it still, shows that we had the courage to go into these places and may have been catalytic to changing those communities, which I think in some we really were. So that is the direction. If you know the history of who the HUD secretary is right now, then that's where they're going. So I have powder dry, and we're looking for where things are going to be most beneficial to invest. And I'm also don't mind giving my 2 cents and ideas that they should be considering that will incentivize not just investors in distressed communities to invest, but the example that I just gave you, I'm buying in some market rate areas and I'm converting apartments to be affordable and I'm getting a tax benefit for doing that. So I'm suggesting more ideas to get market rate communities to benefit from doing the same thing in a way that would just literally accelerate the ability to build affordable housing. And I like to get in the head of the people making the decisions. And I'm like, Trump was a real estate guy, right? So he understands that some of the suggestions that we're making would absolutely make sense to someone that's looking at real estate. I'm also looking at the trends with AI. I don't think, oh, real estate's going anywhere, right? I think people are going to always need a place to live.
All right. I want to thank both of you for being here. Thank everybody that has stayed throughout and participated all the way through.